Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. Last week was obviously a very rough week for equity markets. We closed the week down about 3.5%, back down to correction territory for the S&P 500. Currently, we're sitting at about 4120. Now, previous low for the S&P 500 coming into this week was about 4,200. We've obviously dropped a little bit below that. And we're down about 12.5%, 13% on the year. So back into correction territory for the year. We'll talk a little bit about the history of corrections towards the back of this update. Ostensibly, right now, what the market is worried about is continued concern over Fed expectations around what they're going to do about interest rates. Later this week, the Fed is meeting. They are widely expected to increase rates, short-term rates, by 50 basis points. There may even be one or two dissents for a 75 basis point raise. In any event, we will see higher short-term interest rates in the very, very near future, and people are slowly coming to terms with that. Second, we've got some concern over inflation pressuring earnings. So both Amazon and Apple came out last week with some commentary around inflation and or supply chain issues that might pressure earnings on a go-forward basis. Amazon actually disappointed a little bit in terms of their overall performance. Apple actually outperformed, but neither stock did very well last week based on their commentary for the second half of the year. And then last but not least, we've got some lingering headlines out there around a Chinese economic slowdown. I don't know whether or not you guys have been watching the news, but China is in the midst of another COVID lockdown that generally impedes economic activity. And when that happens, people get concerned, not necessarily about the Chinese economy, but about the Chinese supply chains and that ability to sort of source goods, or our ability to source goods from China on a go-forward basis. So with 60% of the S&P 500 reporting, performance is basically in line. EPS growth of about 3% and revenue growth about 12%. So first quarter earnings numbers don't look like they're wildly beating, but they're not wildly missing either. It's generally been a fairly in-line quarter. I would just make the comment that with the volatility that we're seeing in the marketplace, it makes it exceptionally difficult to try and day trade or time any of this. You look back at last week, Thursday, the market was up 2.5%. Everything was fine. Friday, it wasn't fine. And the market was down about 3.5%. That's not necessarily logical. It indicates a whole lot of fear in the marketplace. As we've talked about before, it seems a little silly to believe that the entirety of the United States economy is worth 2.5% more on Thursday and then 3.5% less on Friday. Market's clearly in the long term is a weighing machine. In the short term, it's a voting machine. And when times get a little scary, people can get a little fearful. There's also somewhat of a tendency towards the end of the week for people to not want to be long over the weekend, just given the news cycle that's out there. Once again, we always encourage people to just sort of stick to your guns when we get to these times of volatility. It's important to sort of stay the course and follow the playbook that we've created. The second thing that I would just say is that these types of corrections are not that uncommon. I know it feels different. Every time feels like the first time to a certain degree, but there were actually 5 different correction cycles in the 10-year period, sort of between 2018 and 2019. And most of you, if I asked you to name them, wouldn't come close to getting one of them. There was the U.S. debt downgrade, a couple of other interest rate scares, the devaluation of the yuan, a couple other impacts, a couple other events that basically created these types of market sell-offs. And they happen. They're cyclical. They occur every, 2 to 2.5 years within a bull market cycle. Hopefully we do not get an actually recessionary cycle. But it's just important to note that this type of volatility is expected within the marketplace. And in general, most portfolios are designed to sort of accommodate this type of volatility. So with that, as always, if you have any questions, please don't feel, please feel free to reach out to myself or to your advisor. As always, I hope you're having a great week, and I look forward to talking to you soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.